Thank you, EL. My name is Michael AZLEN. I'm here from Frontier Investment Management based in London. I'll tell you a little bit of background before going into the presentation. I'm a Canadian. I've been living in London for 23 years now. I did my graduate degree at London Business School, and I now teach part-time on the master's degree program at London Business School. I've been in the investment management business for approximately 26 years. What I'm going to lecture on today, this very short presentation, is to give you a brief overview of some of the most important concepts in investment management. I'm not going to really talk about our funds today, a little bit, but mainly this is an educational presentation that hopefully you can learn some important concepts in investment management. The presentation is called The Four Pillars of Investing. There are four key large issues that investors need to understand when thinking about investments. Those four issues are, first, to understand where do returns come from? What is the main source of investment returns? This is important to understand because it's not fund managers. That's key. Number two, asset allocation. How do we build the portfolio and how big is the impact of these decisions? Number three, diversification or modern portfolio theory. And number four, indexing. You maybe have heard of companies like Vanguard or ETFs. What is the advantage of these products in a client portfolio? These are the four things we're going to very briefly cover today. Investment returns, pillar one. Where do returns come from? First, let me give you some empirical evidence. In 22 countries around the world, over 100 years, the average return of the stock market in those countries is 9 to 10% a year. Bonds have been 5 to 6% a year, and cash has been between 3 and 4% a year. That's in 22 countries over 100 years. The furthest I can go back for these four assets, you've got U.S. equities, U.S. bonds, you have a commodity index of commodities, and then the last bar is a portfolio. You can see here that over the last 43 years, U.S. equities have generated a return of about 10.1% a year. Average return over 43 years. The first thing to understand, there are two key things to understand about this number. The first thing is 10% a year compounding for 43 years, this ends up being a large amount of money. Second thing to understand, there's no fund manager involved in that number. So where does the return come from? This is the S&P 500 index, the 500 largest companies in the US, and those companies, if you buy into those companies, you buy into capitalism. They sell product, they control cost, they make a profit, they distribute a dividend, and the capital value of the company grows. So investing in the stock market or the bond market, where companies borrow money, you're investing in capitalism, and this is the principal source of return. Hopefully, if you buy an equity fund manager, the manager makes 11% a year. Hopefully. But most of the return emanates from the asset class itself. We call this the beta of the asset class. Now, if you invest in all four assets, all three assets, you make in the portfolio about 9% a year. In the last 24 years, I've got some new asset classes on the right. You've got private equity, emerging market equity, hedge funds, managed futures, and I've picked a large index for each asset class. If you put 1/9 of your money in each of the 9, you diversified, you make 8.3% a year compounded for 24 years. I submit to you these numbers are reasonably attractive. So we have to understand, first and foremost, where returns come from. But that's the return side. Let's now look at the risk. The way we're going to look at the risk, this is the portfolio, the two portfolios I showed you, which are blended, diversified. we take 12 months of return and we plot this on the graph. Then we move 1 month, the next 12 months. This is called the rolling return. Are you with me, guys? So we have here 500 rolling 12-month periods. Many different 12 months. Bull markets, bear markets, commodities going up and down. You can see here cash. I don't know if I have a laser on this one. Maybe, yeah. Cash is the black line. And here in 2008, you lose 30%. In the next 12 months, you make 30%. 86% of 500 one-year periods, you're up. But we don't invest for 1 year. So let's look at 3 years. If we look at 3-year periods, now 93% of the time you're up. But this is still a short period. So let's look at 5 years. We have 430 5-year windows. Many different economic environments, but there is no negative period. There's not one out of 430 5-year periods, there's not one negative period. It doesn't mean the next 5 years we're guaranteed to make a profit. I don't know the future. But on the basis of a lot of empirical evidence, it would seem to say that if we invest and diversify over 5 years, and if we look at 10 years...
7 years. What about 7 years?
I do have 7.5 years. Is on another presentation. If we look at the 10-year numbers, now you begin to see what academics call the risk premium. The risk premium is the premium you receive above cash, but you have to take short-term market risk. You have to take the short-term volatility, but the market rewards you. This is the risk premium, the difference between cash and the risky portfolio. You can see interest rates coming down over time, but the risk premium has been quite consistent over time. So, pillar 1, what's important? Where do returns come from? Capitalism and from asset classes. Pillar 2, what is the secret to capturing the return? Time. Not every year, not every month, time. Second pillar is asset allocation. I'm going to very quickly go over this. There have been 4 major academic studies into when a client builds a portfolio, what is the main driver of risk and return. The conclusion is primarily it's the asset allocation decision, 50% equity, 10% real estate, 10% bonds, etc. This decision is the most important. You can see the percentages here from each of these studies, the majority of the return. Of course, asset classes have short-term volatility. So you can see at the top, there is the best performing asset class, the next best. We know that each asset class here has what? A risk premium. What do you mean a risk premium? A return above cash, above inflation, but it doesn't pay every year, over 5 to 10 years. Third pillar is modern portfolio theory. 1952, Harry Markowitz publishes an academic paper called Portfolio Selection. He receives the Nobel Prize in Economics in 1990. It took a long time, but eventually he was recognized.
That's MPT, right?
MPT, correct. And what Markowitz's innovation was, in the 1950s, investing was return and risk. Markowitz brought the third dimension in, which is correlation. If I can bring an investment into my portfolio that is not correlated, it moves differently, I can achieve similar return, but lower risk. And this is a good example to illustrate this. Same data, I've picked a major market index for each asset class. So this is the MSCI World Index, global equities. If I put all my portfolio in the stock market, over 24 years, it makes 7% a year with volatility of 14%, but I lose 50% twice. In 2000 to 2001, goes down 50, recovers. And then in 2008, down 50%, recovers. You do recover, but this is painful and stressful. If you have a little bit of bonds in your portfolio, you add real estate, you add emerging market equities, you add hedge funds, you add managed futures. This is the asset allocation of our fund. you can see as we add more assets, the return is about the same. But the risk, of course, is lower because we are diversified. It's a quite easy to understand concept, but here you can see it in practice. Interestingly, what we are looking for are asset classes, investments that can provide protection and uncorrelated returns. These are the 5 largest drops in the stock market in the last 30 years. So this is the most stressful period. On average, the stock market falls 30%. Commodities, on average, are up 1% in the same period. So maybe this might be something good to have in a portfolio. Hedge funds are down 3%. And managed futures, a very interesting strategy, has a strong negative correlation when the stock market goes down. So on average, in these periods, managed futures is up 20%. So we like having this allocated in a portfolio when we own equities. We want to own both assets. Managed futures may not be a strategy you are familiar with. It's an alternative investment strategy that has been around longer than the hedge fund industry by about 10 years. So we now have approximately 30 years of data on the managed futures industry that can be analyzed. I showed you some of the data. And managers trade futures contracts that are daily liquidity, fully regulated, on exchanges around the world in equity indexes, bond indexes, commodities, and currencies. And the main strategy employed by these managers is trend following. To put it simply, when something trends up or down, they will go long or short. Going short means you make a profit when the asset declines. So in the last 14 months, these managers have had a short position in oil. And as oil declined, the trend is down, they make a profit and the trend is down. But while oil was going down, the stock market has been generally going up. So again, you have diversification. When we look at an investment strategy at Frontier, we're seeking 2 things. First, empirical evidence, the data. We want to look at the quantitative data. And then second, we want independent confirmation from academic research, peer-reviewed academic research. In this case, I can tell you there are a number of high-quality academic papers that have been published that corroborate the benefit of managed futures in your portfolio. 2.5 years ago, after investing in many external managed futures funds, we developed and built our own trend-following program. And we've been running that for 2.5 years. We were very fortunate because in 2014, there were significant trends. You may remember, of course, we had the energy, oil and all the energy commodities falling heavily in 2014. The US dollar rallied very strongly. Stock markets were going up. So there were lots of trends. And most of the managers in this strategy, including our own strategy, we did very well. We made a 40% return in 2014, most of the managers also had very strong returns, and we're now launching this as a daily liquidity, fully regulated fund in the United Kingdom this coming summer. And hopefully, thank you to Financim for having me speak. Hopefully we'll be working on that and with our Emerald partners to tell you more about that in the future. If we look at modern portfolio theory in a little more practical sense, what I would like to show you is some of our research on how Harvard University and Yale University invest their charitable endowment. So Harvard has a $36 billion endowment fund. You may be familiar with this. This is a charitable pool of capital accumulated over the last 100 years from donations. And this endowment fund is used to fund about 1/3 of the operating expenses of the university. So teacher salaries, heating, lighting, and it provides scholarships for children who can't afford to go to Harvard. The way they invest this money is very unique, and they have been very, very successful. They invest about 50% in equities, 10% in bonds, and 40% in alternative assets, real estate, commodities, hedge funds, natural resources, managed futures, and they diversify the portfolio. Over the last 10, 15, and 20 years, this is a traditional portfolio, and this is what Harvard and Yale have achieved. They are seen as some of the most outstanding institutional investors in the world. I travel globally and speak to the top institutional investors in the world. Everyone admires these as some of the top investors. At Frontier, we believe that asset allocation is the main driver of return, because that's what the academic research, and it makes sense, tells us. So the hypothesis we developed was, why don't we invest like Harvard and Yale? We'll invest 50% in equities, 10%, and we'll build an asset allocation and a portfolio that way. And to test this hypothesis, we took an index for each asset and we built a theoretical endowment index portfolio. We collected the actual asset allocation every year of Harvard and Yale. So we have how much in each asset, and then we recreated the portfolio. You can see here that you don't perform as well as Harvard and Yale, but you do quite well. In addition, you're better than a traditional 60-40 portfolio. So it kind of corroborates our hypothesis that investing in this manner is probably a pretty good idea. Finally, I'll just close very quickly with Pillar 4. Again, I don't have time to speak about this accurately or in full detail now because of time restrictions, but someone like Warren Buffett says the best way for an investor to own equities is through an index fund, because you're sure to beat the results of most professionals. We saw at the beginning that over the last 100 years, the S&P 500 index has done about 10% a year. If you buy an index fund, you get 10% a year minus the cost. The cost is only about 1/10 of 1% a year, so it's very low. Indexing, other very successful investors promote indexing. Jack Meyer ran the Harvard Endowment Fund for over a decade, very successfully. And he says as well, many people think they can find managers who outperform. I would say that 85 to 90% of managers don't beat the benchmark. Now the reason for this, and if you look at the empirical evidence, it's very clear. About 75% of managers do not beat the index. But the more interesting point is this. Every year, approximately 1/3 of funds do beat the index. They do not repeat. This is very important. On average, they do not repeat. Otherwise, it would be easy. We look at last year's best performers and we buy them. Unfortunately, we looked at 100 academic studies in 4 countries globally, and that does not occur. The only funds that do repeat are the worst performing funds. The worst performing funds tend to repeat year on year until they close. When you analyze these worst performers, you usually find 2 criteria. First, they have the highest management fees. And secondly, they trade a lot inside. And what happens when we trade? Costs. We pay commission. We pay a bid-offer spread. We pay market impact costs. We push the price up and down. Who's helping us to trade? Well, JP Morgan's helping. Look, John, we have a great report on this stock. It's looking excellent. The managing director's got a new product in FDA trials. Buy. Jim, unfortunately, the CEO's resigned on this company. Sell. Billions of dollars is sucked out of funds from investors, pays commissions to the banks. Right? So we have to understand how the system works. You can see here the management fees, of course, of an active fund are much higher, but below the iceberg, the hidden fees are also much higher. So in a nutshell, indexing, why would we want to index? If I buy the index for 10 basis points, 1/10 of 1%, if the index is up 23%, I make 23. I don't make 24, but I do know that I beat 2/3 to 75% of the managers. Some managers will beat me, but it's hard to identify those managers in advance. Very quickly, you have been a very patient audience. I hope that you have gotten very briefly a flavor of the educational workshop. This is a small subsection of the full educational workshop. Maybe one day I will be invited to do the full workshop for you. What do we do at Frontier? At Frontier, we employ these four pillars principles in a fund. It's a core fund that invests in all the asset classes. We have a low risk, lower volatility version and a higher risk, higher volatility like Harvard and Yale. And we use index funds on most of the asset classes. For the alternative asset classes, we use active managers. So we use both. We invest in all the asset classes. So you have about 15,000 underlying securities in one fund. You're fully globally diversified. And we're accessing most at very low cost, between 5 and 10 basis points. There are two versions, as I mentioned, with different risk profiles, so you can blend them to achieve something in the middle. And that really is my presentation. I'll just mention once again, we are launching, I think, what is going to be a very interesting new fund, the Managed Futures Fund, which has this interesting correlation properties to help defend against an equity bear market. If there's time for questions, otherwise, sure.
I have two questions. First one is how much percentage does the future index takes from your entire portfolio?
14%.
14%?
One four.
Okay. And the other question is this already makes you ignore news completely? You only make decisions by the MPT, the percentage of the portfolio, and you ignore news. Is that the idea?
I wouldn't say we ignore news, but what I would say is that after 26 years in this business, the reaction to news, I would say 80% of the time, most of the reaction to news is takes away from return, doesn't add to return. This has been, my experience. However, we don't ignore new information, so we always are trying to improve. We analyze and publish a report on the top 20 university endowments every year. So we look at the big five, first Harvard and Yale, but then we also look at Princeton, Stanford, and University of Texas because they're the biggest. And what we're interested in is looking inside their portfolio, particularly in two areas, the alternative investments and the private equity. Because these two assets they have particularly good performance in, and what we're hoping to do is improve the fund in these two areas to boost and get better returns, lower risk. So every quarter we rebalance the asset allocation every quarter, and once a year we do a big strategic reset of the asset allocation. Short-term news, I don't know, OPEC signs an agreement, do we react? No. And again, my view would be many times to react to these things probably takes away from return. It's very hard to make short-term and get them right, has been my experience. Yes?
Two silly questions. What will be next year? And what Buffett thinks about you?
I don't know what Buffett thinks about me. I have not met him, so I don't know. I do know that he is a fan of using indexes for clients to get exposure to the stock market. So I do know that because that's a quote. Sorry. Your other question was, what do I think will happen next year? I have no idea. I have no idea. I could, though, build a very good story for you, because you can see I'm a good presenter. But my opinion, and I do have an opinion about the market, my opinion plus $1.50 gets you a coffee at Starbucks. and after 26 years in this business, making accurate predictions about the macroeconomic economy, and even if you forecast the macroeconomic economy correctly, the market does something different. It doesn't react to how you think, because macro does this, the market often does that. It's very, very difficult, particularly in the short-term horizon. If you said to me, Mike, what do I think, will I think the stock market be higher 5 years from now? Then I have more confidence.
7 years.
Yeah, or 7 years. Now my confidence goes up even more. I say, yes, the market will be up. It won't be down, it'll be up. I feel confident. But the next 2 months, 6 months, 12 months, very difficult.
Okay, the last question, what do you think about the commodities? What happened?
Yeah, there are two things happening in the commodity complex right now. First, obviously, you have the shale gas phenomenon, which has flooded the market with cheap energy, and that has brought down the price. You have conspiracy theories that OPEC now increased production to bring the price down to close the shale gas. And of course, when the price has come down, this has closed shale gas. But if the price moves back up, they can open the taps in the US and bring production. So my view is probably energy remains relatively cheap. The second interesting thing that has happened in the commodity complex is commodity futures trade out to 1 year period. If you look at what the cost of a contract is 6 months, 12 months, 1 year, 2 years, the curve is in what we call contango. It means the price of a barrel of oil today is 40, but 1 year out is 46, and 2 years out is 51. So the curve slopes upward. So if I'm a buyer of energy, if I buy oil for delivery in 6 months, I buy at 46. If the spot market, the current price, stays at 40, by the time I wait, I hold the contract, I wait, I lose $6 a barrel, which is why many the speculators are renting big ships and loading them with oil, and they hold them offshore, waiting for the price to increase. So there are some interesting things happening in the energy market, how it's traded, and I think the environment.
Thank you very much.
Excellent. Thank you very much.